So in this video, I'm going to go ahead and highlight a macro indicator that could pretty much enlighten us of large moves in the market that a lot of people tend to ignore. Now, for those of you guys that are not familiar with the channel, one of the things I often speak on is having a holistic approach in regards to participating in the market. This is why I don't often just rely on one data point, but actually just use a multitude of different data points in confluence to kind of have a better idea of what's actually taking place. This is why I'm often always looking at the news, and I'm often looking at the fundamentals of a company, the technicals, monetary policy, fiscal policy, geopolitical risk. We're also often talking and looking at, pretty much what's going on in the macroeconomic environment, and then also alternative data, and kind of mixing that in all together to kind of see what's taking place. And that's why oftentimes when I share my trade ideas within my public videos, but also within the Push and Profit private group, it's often a lot more accurate than someone who's just using one data point, because again, we're looking at a whole list of things all together. And so in this video, I want to go ahead and talk about a macro data point that's pretty helpful in actually understanding where we are in the business cycle. And the reason why I want to go ahead and talk about why the business cycle is important to pretty much understand is because what a lot of people tend to forget is, regardless if you're trading or you're investing in the long term, whatever your approach is in the market, short term, long term, a lot of people tend to forget that you're actually buying and selling a portion of a business. And so you have to understand what could influence a business to have some success or have some failure. And there's a lot of different influences. And so one of the things I like to look at is macroeconomic data. And we often talk about the CPI report, which is a gauge on inflation, or several other reports. But in this video, I want to go ahead and talk about something called the BDI, which is the Baltic Dry Index. Now, the BDI is a composite index that measures the cost of shipping raw materials such as iron, ore, coal, and grain by sea, and it serves as a leading indicator of global economic activity, reflecting changes in demand for bulk shipping. Now, when you're looking at companies that are involved in some sort of manufacturing or selling of goods, you want to understand, well, are people actually buying their products? Because at the end of the day, people are not buying them. Well, that is not going to reflect very well for the company, and it's not going to do very well for the stock, and the stock performance is going to be very poor. And so a simple analogy would be looking at a company like Apple, who of course has a product like the iPhone. Everyone knows what the iPhone is, or hopefully you do. If you don't, it looks something like this, not as cracked as mine, but hopefully something like this. If it doesn't look like this, then I don't know what you're buying, but it's a product that needs a steady supply of components to produce. And so if there's a bottleneck in the supply chain, or if the cost of components rise, it can impact Apple's production costs and ultimately its profitability. And so the BDI reflects the balance of supply and demand in the shipping industry. And so if demand for shipping for raw material increases and there's limited shipping capacity, the BDI rises. And this rise indicates higher shipping costs, affecting businesses that rely on importing or exporting goods, similar to how Apple's supply chains can affect its business. But one of the things I like to do in confluence with looking at several other macroeconomic reports is looking at the trend of what the BDI is doing. Because of course, if it's high, well, that can indicate that there's growth in the economy. There's demand for raw materials and manufacturing and shipping, and that's good news. But inversely, well, if it starts to fall down, well, that's not good news. Very plain and simple. Now, the BDI report has 3 separate layers, and that's pretty much what makes up the entire index of the BDI. And those layers include the capsize index, which tracks the largest vessels primarily used for iron ore and coal. But you also have the Panamax index, which covers medium-sized ships that can navigate the Panama Canal, used for various bulk commodities. And then on top of that, you also have the Supramax index, which includes smaller vessels used for a wide range of bulk cargoes. But of course, it's also important to understand, well, what percentage of these 3 main categories are weighted into the overall BDI index. And just to kind of break that down, we have the capsize index, which represents about 40%, the Panamax index, which represents 30%, and the Supramax index, which represents 30%. So overall, it's almost pretty equally divided between those three sub indices. And so when you're taking a look at the BDI index, it could give you a gauge of how the economy is doing. Of course, again, you want to use it in confluence with other data points, but I want to go ahead and hop into my laptop and kind of just show you guys just exactly how I interpret it and what trends that you could be able to identify. So with that said, if you haven't done so already, by the way, make sure to hit that like button, subscribe to the channel, and also make sure to check out the links in the description below, because one of the links is going to be a link to join the Push and Profit private group, where every single day the markets are open. I share a daily briefing highlighting what's going on in the overall economy, as well as some trade ideas. And again, guys, you could cancel at any time, so make sure to check out the links in the description below. But with that said, let's go ahead and hop into my laptop. Alrighty, so we are officially in my laptop taking a look at the Baltic Dry Index, aka the BDI, and we're going to go ahead and unravel how, by looking at this, you could have a better understanding of what's currently taking place within the economy. We're also going to go ahead and break down some of the trends that we saw within the last few decades so that you guys have a good idea of how you could go ahead and use this to interpret what's currently going on. Now, I do want to mention that you don't need anything fancy to get a hold of this chart. You could simply Google it, Baltic Dry Index, and you'll see a plethora of several websites that offer this chart for free. You don't need a subscription to something fancy like the Bloomberg terminal that's going to, cost you anywhere from 20 to 40 to even 60,000 per year, which of course, it's a great tool, but there's so many free resources out there, and I often try to share a lot of them on this channel. And in this video, we're going to go ahead and talk about something that a lot of people are not familiar with. So, one thing I do want to address is that when you're looking at the Baltic Dry Index, there's a lot of nuance towards it, right? It's not like, hey, this is up here, this is great. Generally it is, but you have to understand what companies benefit from this going up or having a huge spike. For example, if you're looking at the Baltic Dry Index and it's high, well, this could either be positive or negative, really depending on the type of company and its role in the global supply chain. And so we have to go ahead and break this down. For example, if you're looking at shipping companies specifically, well, of course, if this is high, this is great for shipping companies because a high BDI is generally positive, as it means higher freight rates, leading to increased revenues and profitability. Also, that means that there's higher demand for shipping services, which can strengthen market position for shipping companies specifically, but also for commodities, right? Because again, these ships often move a lot of commodities, and so a high BDI indicates global demand for raw materials like coal or grain, which could benefit producers of these commodities. And so commodity producers may see higher prices for their products, which would increase their revenue, right? But ultimately, the general view of this is that as this is high up, this often signals robust global economic activity, as increased shipping demands reflect higher industrial production and trade volumes. And so generally speaking, this is good when this is high. And of course, when it's low, generally speaking, it's not that great. But there's some nuance towards this, as I said, right? For example, if you're a company that relies on importing raw material or exporting finished goods, you may face higher shipping costs when this is high. And this is not good if you're facing higher shipping costs, because this could squeeze profit margins. And so that creates operational challenges, as higher shipping costs may lead to increased overall production costs, affecting competitiveness and profitability. Now, there's also supply chain pressures. Companies need to manage increased costs within their supply chains, which can be challenging during periods of high shipping rates. And so some companies may need to pass on the higher costs to consumers, which potentially reduces demand for their products. And so again, there's nuance to this, and you can't just say, oh, well, this is high, well, this is good, right? You have to know what companies may benefit, but overall, a good sign of the broader economy. But now, parsing through some of the different time frames in the decades, we're going to go ahead and highlight how the big moves in BDI report kind of showed us a story of the economy. For example, if we take a look over here from 2003 to 2008, we saw this period of the significant rise in the BDI, which peaked in 2008. And the primary driver was the economic boom, particularly due to rapid industrialization and urbanization in China. And of course, the demand for raw materials such as iron ore and coal surged, which was pushing shipping rates higher.
And so we ended up seeing that, but then we ended up seeing this kind of drop right in towards the end of 2008, right before the financial crisis in 2009. And what we ended up seeing, and they call it the '08, financial crisis, the BDI plummeted drastically due to the global crisis, right? We saw financial institutions led to severe contraction in global trade and industrial activity, right? Of course, you have to look at the labor markets. That's why we also pay attention to the labor markets. A lot was going on, and eventually, when everything kind of started pushing downwards, well, shipping rates started coming down. And so we had a very difficult time, but we ended up seeing a bit of this partial recovery from 2009 and 2010, and this was simply due to stimulus measures and economic recovery efforts globally, which helped demand for shipping, through this period. But then you go to 2015 to 2016, and we have these lows over here, right? And that's because there was a slowdown in China's economic growth, which had been a major demand or driver for demand for raw materials. And then, of course, the global shipping industry faced an oversupply of vessels as many new ships ordered during the boom from the years before were delivered, which led to low shipping rates despite moderate demand. And so that's kind of what we ended up seeing around these periods. Now, you go to a time that everyone's pretty much familiar as it's very recent, right? Even the Gen Zers know this one, right? You have the 2020 or the 2020 pandemic, and the BDI experienced a significant drop in the early session of 2020 as the pandemic disrupted global trade and supply chains, and of course the lockdowns and restrictions led to reduced industrial activity and demand for raw materials. But we had this rebound that was fairly quickly as the economy adapted, as there was a lot of government implemented stimulus measures and demand for commodities started to surge due to infrastructure projects and the recovery efforts. And so if you guys take a look at this, and then you were just to look at the SPY, the S&P 500 or the NASDAQ, right? The markets did extremely well in 2020, 2021, but then 2022, everyone knows, or everyone should be familiar with that, right? We had that bear market, the post-pandemic recovery, and what we ended up seeing is pretty much the BDI once again dropping down. And this could be, again, there was a lot less capital in people's savings after the money that was flushed into the system, and things kind of started taking a toll. Then, of course, 2023 was a good year, and now we're here in 2024 at the time of this recording, and we're seeing that the trend is upwards, and this could continue going upwards, which could show a good activity in the economy, which is great for stocks in general for a lot of companies, right? But this could easily have a U-turn if we end up seeing other areas of the macroeconomic environment kind of have cracks. For example, if the labor market starts to crack, well, that's going to go ahead and deteriorate the shipping activity, because, of course, if people don't have jobs, I always say this, that jobs are the bloodline of the economy. If people don't have jobs, well, they don't have money to go ahead and buy products. If people are not buying products, well, shipping demands go down, right? Or just shipping activity goes down. And if that goes down, well, we're in a economy that's contracting. And so, again, very simple to understand, right? Of course, there's a bit of nuance, but this is a great way to kind of see what's going on in the economy when you use it along with other macro reports. And so right now, things are trending upwards, and as long as we could have jobs not ultimately go to an extreme loss where there's unemployment that skyrockets, if we could just have an unemployment just come down slightly a bit, meaning that, there's a few job losses where it creates this, area where the Fed is looking to now start to impact monetary policy, well, then that could be good. We could have a Goldilocks scenario. And this is why it's very interesting when you take a look at the economy and the markets, because everything's interconnected, right? You often see people talking about technical analysis, drawing support lines and supports, when there's so many different variables that could influence what's going on in the business cycle. And that's why I like to take a look at what's taking place and look at things like the BDI. And again, right now, things are pushing up high, and we could continue on this trend as long as the labor market doesn't deteriorate. But hopefully I don't make this video any much longer than it needs to be. Hopefully you guys got some value in this video. And before you guys go, make sure to check out this next video right over here. And I'll see you guys on that next video. Take care, guys.